We have obviously seen a big migration in the estimates for how many rate cuts we're going to get this year. And what's been interesting is that even with that change, stocks have continued to rally. Do we get confirmation still of all of this from the CPI tomorrow?
Well, first of all, thanks for having me back. I think there's a lot of information that's already come to us, and things are really coming into view, I think, for 2024 pretty quickly. We're pretty far along now in earnings season, with more than 60% of the S&P having reported and representing probably more than 75% of the market cap. And at this point, we believe with what's priced into the S&P, that market participants are giving us a pretty strong sense of the world they expect to inhabit by the end of 2024. And I have to say, based on what it looks like, that looks like a pretty spectacular place to be. They expect to see earnings growth of between 10 and 11%. They expect 6 rate cuts, and they expect inflation to have come all the way down to 2% and really anchored there. And so it's pretty beautiful at the other end of the rainbow. I think, unfortunately, there's a big mountain of economic data, inflation data that you just alluded to, geopolitical risk, a noisy election year here in the US, and a lot of Fed decisions between here and there. And so instead of pricing the market to kind of go slowly and carefully around that mountain, we bid prices up and multiples up, particularly for the S&P, to go straight up the mountain and directly across it. And I think the market is somewhat discounting how treacherous a path that is. We need disinflation to continue across 2024 to get down at least below 2.5% in order to give the Fed the room to start making those cuts. But we can't really see it go too far down below 2% for fear of cutting into the aforementioned growth that's priced in for earnings for the rest of the year. And similarly with the rate cuts, I think we want to see some amount of rate cuts to justify the multiples at which we are, to see the cost of capital start to come down. But too many rate cuts, once we get going on that path, too many rate cuts portend a world where the Fed is worried about growth and is starting to artificially prop us up. And so the market is kind of signaling that they believe in what I'm going to call the immaculate correction of rates levels and inflation levels without any impact on growth. And to the extent we do actually experience that, I think they're going to really reward equities. I think they're going to push prices up, even if that means pushing multiples up further from here. We're already at 20 times forward earning on the S&P versus what the rest of the world is probably closer to about 13 on average. And I think we'll even see the multiples push higher if we do achieve that, what I call immaculate correction. And then obviously there's a lot of ways for us to be disappointed along that path.
And so, Matt, given that outlook, you obviously see plenty of reasons for caution here, some red flags. Given that outlook, Matt, when you look at the U.S. stock market, where do you see value right here in terms of sectors?
We tend to be more, purely tethered to the index. I think within the various sectors, obviously technology is the one everybody's been watching, and it seems pretty bid up. But again, that's where all the growth is expected. I think more broadly, we're looking at U.S. small and U.S. large cap U.S. small and mid cap, and seeing a little bit more value there versus the rest of the U.S. large cap. But again, the game is in the growth, and the growth is really priced at the top of the market right now.
And what do you think all of what you were talking about with the Fed implies for yields, and then how does that feed back to stocks?
I think with the Fed, one of the things that we're really focused on at GenTrust is the assumption of 6 cuts that's priced into the market by the end of the year. It kind of reminds me of that 49ers field goal just after the 2-minute warning, the 52-yard field goal. They lined up to kick it. It's probably a 50-50 kick. So the expected value of the kick is probably 1.5 points. The thing is, you're either going to get 0 or 3. You're never going to get 1.5. I think there's an analogy there for the price cuts that are the number of cuts that are priced into the market, I should say. I think there's definitely a path where we're disappointed with inflation data and the Fed doesn't have room to maneuver, and we have somewhere between 0 and 2 cuts. That's definitely a camp. There's a camp that believes we'll still see that recession that everybody wants to avoid. And in that case, you're going to see something like 12 to 16 cuts. And if you take those two probabilities and you weight them and you average them, maybe you get to 6 cuts. It doesn't mean you're going to get those 6. It just means that that's kind of the average path. And in some funny ways, 2 negative outcomes averaged together create a pretty favorable outcome for equities. And I think that's where the market is priced today, and that's what they're expecting. For somebody who's an asset allocator, as we are, and is concerned about how they want to weight fixed income versus equities, our view is that fixed income is the safer play on balance between that and equities, given that if we see rates flat or even come up from here, you're not going to be too fussed on how quickly you'll earn out of that because you're already getting paid a pretty high rate of return on fixed income. Whereas if we're disappointed on the bottom side, when we get a lot of cuts, you're going to be pretty punished as an equity investor in all likelihood, based on that recession that we're priced to fade. So we think you're much more neutral sitting in fixed income today versus in equities, given the various paths that we see as possible.
And Matt, one last issue I want to get your take on before we let you go is commercial real estate, Matt. You know, you look at these headlines from NYCB. When you look at that, Matt, do you get concerned about what that means for the banking system and the economy, or are you in the camp, Matt, that you think, you know what, no, you know, you look at that bank and think its problems are its own, it's idiosyncratic?
I think that bank is idiosyncratic, though I wouldn't say that I'm an expert on that one. But more broadly, I think that's a timing issue. I think where we're expecting this, where the market's expecting some amount of easing and some amount of relief, would give banks a longer time to manage some of those more challenging commercial real estate loans that they have on their books. And the quicker and more painful that process has to be resolved, the more difficult it's going to be for the market to continue to kind of brush it under the rug.
Matt, thanks so much for joining us today. As always, appreciate the time and insight.
Thanks for having me.